Wow,
Still a
you
trader.
go right ahead. And there we go. We're live.
Just get, hold on. No. Just wait.
Well, no, the
Just
stream
When
is
I
live.
click this thing, got it?
got to make sure it's live on YouTube first.
I'm going to see how many people show up.
No, yeah. Well, we'll. I don't know how to check that, but Danny might be able to type it into the chat when he sees how many people are there.
Okay, yeah, we're live.
All right. Welcome everybody, and I've got Kuppy here, and we're looking forward to a great Q&A. Danny's going to be moderating the questions here when we get started. But I wanted to just, Kuppy, have a quick conversation with you while we're waiting for everyone to log in and start typing in the questions they want to pick your brains on. But listen, we're here just a couple weeks out on this elections. I don't want to get into the politics of it itself, but rather I wanted to first ask you, how much of the recent rally in the markets here do you think is attributable to the fact that Trump is improving in the polls?
I think a good chunk of it is. I mean, you have to think back. I mean, it was so long ago. But when he won in 2016, I remember 2017. He'd come in off the golf course around noon. He'd tweet about how great the economy is. He'd tell everyone to buy spoos, and the market would rally 100 bips. And he did that trick basically for 4 years. And I mean, I think people forget about this because I was short for some of that time. And he'd just come in and just be like, greatest market ever. All the people say it's the best market ever. You got to buy spoos. And the market would rip. And I think people are putting that trade on again. What his policies will do for the market, I don't know. But he's going to be tweeting about the market.
Oh, that's a given. If he's in, he's going to be tweeting about markets for sure. But the question then is, like, obviously there's a whole array of probable outcomes, but the one that currently is being priced in as a reasonable probability is a sweep. A red sweep. How do you see the market reacting if that was the outcome? Do you think the market takes it even that much more bullish?
Yeah, I think the market goes up a lot. Trump, he's probably going to run huge deficits. He's probably going to do a ton of fiscal. I think the market sees as bullish, and I think short term the market will be excited about it. If there's a sweep, I think you have a gap up. And then I think there's an oh shit moment when people see the bonds, legging down a point a day as they have been, and they go, oh shit, And I think you have a bond crisis. That's the thing. The thing that's keeping me from maxing it out, and we run over 100 long, but from really maxing it out is I think you have a bond crisis.
What's the reaction though for Trump if we have bonds like yields running higher and stuff like that? Do you think he does anything about it?
He's not very subtle. I assume he'll do all sorts of weird things that'll confuse the hell out of the markets, because I don't think he actually understands how debt works. I mean, he just piles debt on top of debt. I mean, that's his own personal life. No, I could see a world where he tells the Fed to lower rates, and that just leads, the long end. Basically, the 10 is like, it is the bedrock of the entire global financial system, right? Right. And so when 10s start leaking, the financial system has a margin call effectively. That's why the market's rolling over today. I think that's why things have been weak for a couple of days now. And if 10s start going to 6, he's going to panic and he's going to try to lower rates, and it's going to make the problem worse. The way you fix the 10s is you need to have a proper recession, but Trump will never do that. And so, if you want to fix 10s, you got to raise rates 100 or 200 bips. It's kind of what Brazil does when they get themselves into trouble, or any other EM. We're an EM. And so I don't think he's going to do that. I think he's going to probably make the problem worse. And I think you're going to have a lot of chaos and drama. I think it's going to be a very volatile traders market. I think it's the great macro dreamscape where you sell anything that is in a liquid QSIP and you're only in things that trade 50 million ADV a day, and you just trade them.
Right. Is China a buy down here? Like, what a roll! First of all, what the frig, right? Like, for one of the largest stock markets outside of the U.S. to basically even rip, 40-50% like that is insane. But then for it to swing right back down with the same degree of volatility is crazy. But now, like, we find ourselves back here. Like, do you go and buy this dip? Like, how are you approaching this?
I bought the dip the last couple of days. I don't know if that's the right move, but we had some call spreads already on KWeb, and before they did all the stimmies or whatever they said they were going to do, and I bought the dip. I feel like this is the Draghi moment where they say whatever it takes. They did a bit, and then it pulled back, and everyone said they're not doing enough, and I think they'll just do more and more and more and more. I mean, G's, maybe he doesn't want the market screaming, but he wants to put a floor under it. And as a result, he's going to figure out how to put a floor under it. Look, we're long. It's not a huge position, but it's not a small position. Call it medium. By the way, what are you drinking, bro?
I've got the Portuguese Sagres.
Oh, that's really good stuff, actually.
It's something you could stock in the fridge. I actually probably maybe give it a 6 out of 10. Look at the amateur score, Danny.
It's better than the medalla. I give this like a 4. But it's Puerto Rico and it's like 120 degrees outside, so this is all we drink.
There you go. Listen, one last question, and then we're going to invite Danny on here to start answer or at least pitching all the questions that our live listeners are pitching at us. But I wanted to just ask you, like, going forward in the next 6 months, like, what scares you the most? Like, is there something that makes you nervous?
Bonds. I think we have a Liz Truss moment in the next year, and I think that's what supersedes everything else. I think 10's blowout, and I think the world is a global margin call. Look, it's 600 bips on the 10, which is still tight of where nominal GDP is, and probably tight of where CPI is. I mean, I don't buy this 3% thing they keep telling me. I wish my costs only went up 3%. I mean, they say healthcare went down last year. Like, I'd like to buy some of that product. Like, where's the link? I want to click and get some. And no, I think you have a bond crisis. And at 6 points on the 10, basically every bank's insolvent, and they have Mark II and insanity, and they can just like extend and pretend. But when you have to pay depositors and you're running negative yield, like that mark to market that doesn't get realized for a couple of years, it comes through your income statement. I think the whole thing blows up at 600 bips. And look, the 87 crash was a bond market issue. The bonds panicked. We haven't had a proper bond panic really in the United States in 30 years. They had one in the UK and everyone freaked out. Bond panics are funny because bonds are, a credit instrument. It's an asset, it's a liability, but it's also very, very levered. No one puts straight 10s on. Everyone's always levering it, using some other piece of the curve to fund it. Everyone does something else. And so when you have a highly levered thing and half the people are, naturally betting the wrong side of it, half the people are betting the right side of it, so, kind of zero-sum market, weird things happen. And they tend to lead on themselves with margin calls. I just think that's what blows up. I mean, I maybe been a little early on this call, but I haven't been wrong. I mean, bonds are just trending in a perfect trend line. They leak, they consolidate a couple of months, they leak, they consolidate. No, I think the next leg down is 200-300 bips, and it scares the world.
It's funny because I was going to ask you just before we went live was there you go. But I was going to ask you as to whether or not because obviously my partner here there's like a uber bearish bonds, and I was like,
he's not bearish enough.
And see, I'm like the idiot that's not overly bearish. I think, but I was going to ask you if I'm the idiot, and clearly you're stating yes.
No, not idiot. I just think you're facing the wrong way.
Yeah, there you go. Anyway, Danny, come save me. All right, buddy.
You're doing a great job.
There you go. All right. So listen, Danny, I'm sure the questions are rolling in here. Why don't you start pitching some of the questions here to us?
Sure. We'll start with number 1 from Spoo's Trader. So, is gold still a buy at this point? Do you prefer the physical and no miners?
Pardon, repeat that? I missed.
So, Spoo's Trader asks, is gold still a buy at this point? Do you still prefer the physical and no miners?
Gold's still a buy. It's gone straight up 700 points. It's got to pull back, right? I wouldn't buy it up here. I mean, I haven't bought it up here. I'm the age who sold mine, after the first surge. Miners suck, but look, the price of oil is down. The spread between oil and gold's blown out. I mean, I'm bullish oil, right? But I'm more bullish gold. I think the miners might actually have their 6-month window where they outperform every 20 years, but I have no position. But about 6 months every 20 years, miners outperform.
I am in the camp that as well, that basically on the short term, it's a very heated market. So if it feels very much like we're in the kind of like seventh inning stretch of whatever move is happening. And at some point, just like what uranium did at the start of the year, it got overheated and then spent half a year backfilling. And at some point, gold is probably going to do the same thing. Does it first go to 2,900 or 3,000? It could, but I think at some point that's going to run out a little bit of momentum, and it's going to spend some time consolidating. I'm not going to make me bearish gold. It's just I just think that this is the wrong time to be chasing it.
Yeah, all right. I mean, I think gold goes a lot higher over the next couple of years. It becomes basically the reserve asset and replaces tens. You look at the model portfolio now, and it's 40% fixed income and 60% equity. And you think about it, where it was 40 years ago, it was about 10% gold, and no one had any fixed income. The rest was equity. I think we make that move again. And as allocators, have to go from 0 weight to 1,000 bips weight. I think gold goes a lot higher. I wouldn't own a 10 for the life of me right now, but I'd own gold here. I'd much rather, gun to my head, I'd rather own gold at 2,700 than 10s at 4.25. Put it that way.
Oh, there you go. All right. What's next, Danny?
So we might as well go on, touch on oil, seeing as Spoo's Trader also asked, what's the playbook on oil now? Just suppress until the election is over or something else?
You want to take this one?
Well, I mean, I think that oil's found some sort of a trade range. Like it's, you can see every time the thing dips towards the bottom in the range, it bounces. Even, inventory builds and other things like that came out this morning quickly. It didn't lead to follow through selling, which basically means I think oil's finding like a fair value zone, but that doesn't give it a bullish catalyst. But so, I'm curious though, like as to what you think about these energy companies, because like, I mean, okay, making the call on oil, well, maybe it is probably closer to the low end of its range, but when does you start allocating monies to some of these beaten down energy names? What's your thoughts here?
Well, I think I'm kind of in your camp. I mean, my view on oil has evolved over time. I'm more of a 70 floor, 90 ceiling, and it's range bound. There's just too much damn oil, and it's too easy to bring on short cycle supply for it ever really to moon outside of some weird geopolitics. I think it's just range bound. I think the equities are cheap if you assume a high 70s, low 80s mid price in that strip range. But it's not the most exciting thing. I think offshore energy is probably the most attractive thing on my screen right now. All the drill stocks, they're irreplaceable assets. They are appreciating, I think, in value. Rates are going up, and they mostly trade at about 2 times deferred backlog right now. I
Gucci'd it for you, right? When I started buying like 3-4 weeks ago, I was like, I messaged you and it's like, I'm taking a shot here, and I Gucci'd it. I'll tell you when I sell.
I'm buying size every dollar down. I'm such a masochist in these things. It's by far my biggest portfolio weighting, and I've literally been selling every other QSIP on my book to fund it. Eventually, sometimes things get cheap enough where you just kind of say fuck it, and you sell everything else to fund one position. And sometimes it turns out fabulously well, and sometimes you feel like a moron at year end. But this feels like one of those moments where I just pyramid into the thing. This is the only thing that really excites me right now in the book. Outside of some of the gold stuff I own, that's like going to do well if gold is at 2,500, does well if gold at 3,000. Those are the 2 pieces of my book I really am passionate about right here.
Right. All right, Danny, what's up next?
So one from Oscar. What's your opinion on Bohr? Is it BORR? Is that right? Am I saying that right?
Yeah, Bohr. I like the people behind it very much, actually. I'm good friends with them. I think it's well managed. I'd say the knock against Bohr is it's jackups, and all the new discoveries are happening in deep water, and I'd much rather be long deep water than jackups. And so, it's kind of the right neighborhood, but not the right asset in my mind. I think there's people who would see things very differently. But with Saudi dumping jackup rigs into the market, it looks like Pemex is doing about the same. I don't know. It's harder. And then Bohr has something of a levered balance sheet, which makes it harder as well. It's more of a swing asset. So if you really like the sector, this is the beta play. But if you're neutral on the sector, it's also the beta play. But I think that people behind it are the best operators in the industry.
Any comment there, Pat?
Absolutely not.
I have no position there.
Okay. So next up from CH, if Republicans won, is it bad for offshore drilling and oil and gas industries as a whole?
Why would it be bad? They're going to tell everyone to go drill like crazy. That sounds like the bull thesis.
Well, I mean, can provide extra supply, I guess, right? Like, but
yeah, but you have to understand, offshore break-evens are in the 30s. Permian break-evens, they claim, are in the 60s, but I don't believe it because no one's making any money. Right. Bakken everywhere else is higher break-evens. So I see a world where offshore goes from being, call it 25 million barrels a day today, 10 years from now is 45 million barrels. And they've just basically taken all the market share from onshore, or at least high-cost onshore like the Permian. And offshore becomes more of a fast cycle thing too. Once you get your FPSOs in place, and once you have, all your tiebacks in place, you can just go pop some wells in really fast. I mean, seismic 4D, everyone knows where the reserves are. You pop the things in, and it's not much different from Permian. Maybe Permian takes 3 months to turn on. This stuff takes 6 months to turn on. And so I just think it ends up being a low-cost replacement for the Permian with way better ROIC. And yeah, I mean, when they say drill, baby, drill, I think they really mean go to the Gulf of Mexico.
I love it. I'm not going to object.
Any comment, Pat?
No, I'm not going to object. I would love to see it turn around.
Okay.
But I mean, like in the end, it's always been on the Democratic side to kind of curtail energy production, and so if there was a red sweep, it would certainly allow the investment in the energy space to kind of have the green light to keep going.
That's why you always buy the services and not the producers. The producers really do well in a super spike because they earn excess returns for periods of time. But excess returns just basically goes into more drilling. So right. You just kind of want to own the service names.
Well, do you have any in mind? Like, okay, obviously there's the OIH. You could just play the oil service ETF as a broad thing.
Oh, just buy offshore. I don't think onshore. I think onshore is going to cede market share for years into the future. You don't want to be in dying industries.
Right. So like you're trying to avoid the Schlumbergers and focus on
they're hybrid. I mean, look, I think the Weatherfords and Schlumbergers do just fine. Though, I mean, if you look at Schlumberger, look at their most recent Q3 earnings report. The first 7 bullets are about AI and NVIDIA. And I mean, they're a digital company now. They don't do something with oil. And the last bullet point has something to do with carbon. I mean, these guys have lost their fucking minds. They're an oil company.
They used to be an oil company anyway.
No. I mean, they're talking about like generative AI now. Like, yes, the main beneficiary of AI is going to be oil because they can take all this data from seismic, from all the other things, and they have data coming from multiple wells in a basin, and they'll tell you how to produce more oil from it. That's what the AI is actually going to be used for.
Right.
But they'll never give this an AI multiple. But no, I think those sort of companies do fine, those service companies. I just wouldn't own the drillers onshore. I'm not a big fan of any of this, the onshore compression, none of that stuff. Frack, none of it.
All right.
Okay. So next question. There's a few people asking your thoughts on the US housing market. Anybody want to go first?
If interest rates go up, housing kind of sucks, right? I mean, look,
that's an interesting thing, right? Because the question, obviously, they were pricing in 8 rate cuts at the right before the Fed meeting, and so obviously the thought was that mortgage rates were about to go down. But I mean, if you turn around and see the 10-year and 30-year blowing out, like the yields blowing out and the bonds collapsing, I mean, that's going to put interest rates out of reach in many cases on those mortgages that are often linked to this kind of rate market. You think that that's a big concern for you, obviously, right?
Yeah, I wouldn't touch anything that needs rates to survive. I mean, plug 10% in on your 10-year, And if your business doesn't prosper in that world, then you need to exit. Like, the only thing I actually feel passionate about right now, besides gold going up over the rest of my lifetime, is that bonds are going to go up a lot. Like, that is the only trade that I think matters. I'm not
yields
sure
you're saying yields are going to go up.
Yeah,
bonds,
bonds down. I don't have any trade on for that right now. I wish I did, because it's the thing I think most convinced in. But yeah, I think housing does terrible. I would say, though, I spent a decade of my life in Outer Mongolia, and they did their version of Operation Twist in the mortgage market because they wanted people to buy apartments, and they subsidized mortgages at 8%, and at a time where inflation was running at 3 to 5% a month, you could get a 5-year fixed mortgage at 8%. And so you're picking up, let's say inflation is running 30%, you're picking up over 2,000 bips of positive, carry on that. And every person who could get a down payment did the down payment because the home was effectively free because you had to pay it back in depreciating Tugrug. And I think eventually in the U.S., we're a nation of homeowners. I think both political parties want to see home ownership increase. They want to make entry-level housing affordable. It's very popular. I think we'll eventually find a way to subsidize housing again. It'll be low-income housing, affordable housing, entry-level housing. And I think we'll find a way to solve for the fact that rates are going higher. But first, you need that first plunge in the first surge in rates, where politicians say, hey, wait a second, we have to step into the free market and intervene here. And we haven't had that yet. I mean, wait until you have the debt crisis. Wait until you have the bond crisis.
Yeah, the big question always is about time frame. I'm always in the camp that it's farther out than everyone thinks.
What's further out?
A crisis. Like, I don't think
it isn't. So look, the United States has been insolvent since the first day I got into the finance industry in the late 90s, okay? There were guys like Doug Casey who were writing books, and I love Doug. He was writing books 30 years ago about this, 40 years ago about this. He's still writing books about this. He will eventually be right. I think what they missed is that this was always an actuarial sort of thing, okay? The actuarial said, you guys are insolvent. What do we have? We have like 10 times the GDP in outstanding liabilities to ourselves, basically, mainly to retired people. This was always actuarial. Like, there's no doubt that this was factually true, and the liabilities get worse and worse. It's exponential. The difference is that it was actuarial. Now it's a cash flow thing, because 10 years ago, my dad was paying into the system, and now he's taking out of the system. My dad was born in 46, so he's the first wave of boomers. So he was paying in, now he's taking out. As more people like my dad stop paying in and taking out, there's fewer people like us on this call who are subsidizing my dad. And it becomes a cash flow problem. And you don't go bankrupt when you have debt, as long as you can roll the debt. You go bankrupt when you have a cash flow problem. And there's a cash flow problem now. And that's why these things are starting to really accelerate.
Fair enough. All right.
Okay, so we got a few people asking about treasury bonds, treasury yields. So in particular,
I think you know where I stand on that.
Yeah, we just had that. So
that's what I thought. So, so yeah, let's move on to a different one then, maybe. So somebody's asking about your opinions on S&P leaps.
S&P what?
Leap options.
Oh, I think the right tail is the most mispriced thing out there. I mean, these things should be, look at the 1,000 on SPY for 2030 or whatever the furthest duration is. It's probably a quarter of where the implied vol should be. I think right tail is the cheapest asset you can buy right now, and I mean the problem is it has like zero delta, so it's hard for me as a hedge fund to put this on because I have monthly returns. But I think for someone in their private account, they should put a huge. I think it's a mispriced asset. I like buying mispriced assets. I buy huge amounts of tail exposure, go out to 2030 or whatever you need to do, and I'd fund it with some puts because I like the Texas hedge.
Well, any sell the puts to buy the calls. Absolutely, that's a classic one. The other part, like. Obviously, the calls always have a little bit of a premium as interest rates rise. So if you have the call that you got a 10% 10 yield 10-year yield, which is not my call, by the way, but it's your call. But if that's your call, then you're going to have the row component of long dated leaps discounting much higher interest rates, which is going to give you a huge kicker on it's a bet on interest rates to go that far out if you're going out multiple years, especially if you're going out to like the 2 to 5 year kind of time frame. It's discounting a lot of interest rate. It becomes almost like a bond component in some degree or another when you're discounting that kind of rates. Anyway, it's if you think that rates are going up, but the question then, Kuppy, is like, at what point do higher rates impact the market? Like, companies have to access debt.
Oh, I think we have a smash first. I mean, look. We've spent a lot of time on Turkey lately. Okay, everything trades at 2 to 4 times earnings because interest rates are crazy high. But then you look at, I don't even know if they'll quote you, 100% out of the money call option on the index. But if they did, it'd probably quote you at like 100 vol or something because the skew is so screwed up. No, I think you have a terrible smash because rates go up.
But what level of interest rates would the stock market start to give a fuck? Like, because like right now the stock market doesn't seem to care about the fact that we had like a 75 basis point move.
When Yellen did her funding thing and she kind of squeezed the market a little, and maybe she squeezed it, maybe some shorts got over their skis a little. If we take out that level, was it 510, 515, wherever that panic level was about a year ago? If we take out that level, I think that's when the market panics.
Right.
Look, at 600 bips on the 10-year, you don't have a financial system. Just remember that. Like, that is the only collateral in the system, and you don't have it anymore. Like, every bank fails. Look at Buffett. He can't sell Bank of America fast enough. He just put it into T-bills. I mean, he's like 98, right? So he has no idea what he's doing anymore. But, look, he had like a 5-bagger in a bunch of Japanese trading houses. I mean, it was the most impressive thing ever. He went into a bunch of these 50 billion market cap things, and he had a 5-bagger in them, and he funded it with 0 cost yen. Like, I mean, all my hedge fund guys are like a third his age, and they can't even put that trade on. Like, that was ballsy and smart.
There you go.
So maybe he has it figured out still.
By the way, I was like reading some of the questions that are rolling in, and Patrick online here was saying I should get the neon sign that says "Drill, baby, drill." I think that will be the next one. All right, Danny.
The whole Boogie Nights Austin Power thing going.
Yeah, absolutely.
So David Anderson asks, will platinum follow the rip in gold, and silver, and if so, do we play in the futures or stocks?
The chart of platinum looks really good. I'm sure I just Gucci'd it by saying that, knock on wood. We got a bit of exposure through stocks. I probably should be playing through futures, but I don't know. I took a ticker symbol that one of my friends likes, and I'm just kind of rolling with it. I'd rather not say which one because I don't want to shame myself in saying I own a miner. But it's a super small position. It's just not something I feel super passionate about. I mean, I know there's a lot of people who think there's going to be platinum deficits, and maybe there will be. But I don't think anyone really knows what the inventory level looks like. And, platinum goes into catalysts and, whereas there's running deficits, I think the amount of recycling will start picking up as the global car fleet starts aging a little more. And so I don't know, you need a certain amount of working capital in the inventory of global car fleets in terms of catalysts. And I don't know, it's kind of in the too hard pile, but I look at a chart and it's a sexy looking chart. So I put some on.
Well, the one thing, like platinum has more or less been in a 3-year sideways consolidation. It reminds me a lot of the dead period for uranium. Like there was that period where like uranium just was inactive, even though there was a great story behind it. But when these things finally break out, they often build momentum and then start taking off. The thing is that it's still not yet beaten its year highs, so it's not gaining the traction that silver and gold have. But I mean, it's one of those that if you're looking for something that is in the starting block, something that hasn't yet already run, this is one of those things that I think has that opportunity to be that, right? Like it could develop into that. But at the same time, I mean, what the fuck is going to get this engine started? Because it's like gold and silver. I've been really running. This thing is so far lagging.
Such a laggard. And look, winners buy winners. You know, you want to be a momentum trader. I don't want to buy the shittiest ticker symbol in the periodic table. But look, over 1100, I know Patrick's going to buy some.
I unfortunately I actually already have some, but it's you know what's the shit thing is that there isn't any really good places to find liquid options chains in the platinum and palladium space, and I'm a hardcore option trader, so I tend to stay with gold and silver plays because there's just simply the liquidity in the options there.
Oh, I know a guy. He'll quote you some OTC. I know a guy. Let's talk it out there.
All right, you can hook me up. All right, Danny. What do you want to talk about next?
Well, we might as well just finish on precious metals. So copper is the last one. So somebody's asking about your opinions.
That's not so precious, more industrial, but
well, same. It's metal.
Metal.
I mean, the chart is fine. I don't really have a super strong view on copper. I mean, you have to have a view on global GDP to have a view on copper, and I just don't really have a view on global GDP. I mean, if China actually goes ahead and stimmies, then it probably goes up. If China doesn't stimmy, I don't think it matters. And it's in the too hard pile. I mean, look, copper is kind of like 4 bid at 5. Like if you think they stimmy, you're going to buy it at 4.5 and it goes to 5 or maybe goes past 5 a little. I'd rather just buy some Chinese equities that have been totally beat to shit in a multi-year bear market. I mean, you get more upside and they're so beat down, you don't have the same sort of downside. I think it's a better trade. It's just a copper derivative, right? I mean, sorry, it's a China derivative. It's like buying iron ore or any one of those other commodities that just gets fed into China. I'd rather just buy something like Macau casinos, which were long. They trade at high single-digit cash flow multiples, decent dividends, and that's before they stimmied. And we know that if you give Chinese people money, they're going to go and gamble. Well, have you ever been out there? Like, it's amazing. It's just row upon row of guys gambling. It's dead silent too. It's so different from Vegas. And I just think if there's more money in the ecosystem, there's more guys gambling. And I'd rather play that, because it's a fixed cost structure. It's all operating leverage.
Yeah, the copper story, like, it's a very well-known one, and there's no shortage of people that anchor off of the fact that copper is going to be in high demand for all the electric vehicles and power grid rollouts and every other thing. But yet, how much of that news is baked in? Like, what is it that's the next news event that will kind of drive that bull trend? Because that's all known information. I'm dabbling with a little bit of buy on dip on this, but it's purely a tactical trade. I'm not like loading up the long-term portfolio with copper, but it'll be interesting to see whether on the short term I guess I sold some naked puts on it down here around 440. Actually did, but we'll see whether or not these lows hold.
Okay.
Yeah.
Moving on.
Yeah.
So I've had a few people ask, a bit of a random one, but any thoughts on the marijuana trade?
Get it. Not a chance. It's a weed. You literally have a highly regulated market with a huge tax burden competing against guys that do this, illegally, black market. The government has no desire whatsoever to regulate the illegitimate market, and you can't compete with those guys. It just seems like a terminal short.
Yeah, Canopy though recently, was off, had a 40% rally when the thing goes from like $5 to $7 or whatever. At least I'm looking at it on the Canadian market here, but it had a big percentage move. But it's always you got to put it in the frame of the thing went from $12 down to $5. And so doing a $2 reaction off the low looks like a huge percentage return. But the thing is nowhere near, recovering from even levels where it was this summer. And so to me, I'm with you. I'm with you. Like I'm not trusting the breakout. That's all I got to say. I got nothing else, Danny.
Fair. So we've got. I'm gonna go. We're gonna do one more, I think, and then there's because there's obviously a few people asking about uranium. So I thought maybe we could spend the last 10, 15 minutes discussing that. I thought I'd wait to the end because that's.
I don't know if there's 15 minutes of material on uranium. There's a supply and demand deficit.
Okay, well, we'll talk about it in a moment. Let's first get the other question.
So just the last one. So I think it's Leland 103 asked, wouldn't mind hearing about hearing Kuppy mention that one weird crypto he liked way back. I think it was Monero.
Oh yeah, I still own those. I don't know how to sell them now. I'm just gonna be stuck with them. No, I mean crypto's. I'm bearish crypto. I think it has absolutely no use case. I think it's kind of ridiculous. And Ponzi schemes are either inflating or deflating. And I think it's just insanely bearish how sailors stepped up and bought a few $1 billion worth of this stuff. And the ETFs are doing a couple $100 million a day, like $1 billion or $2 billion a week. And they can't break the thing out. Like that's so bearish. And, with interest rates going higher, in my mind, I don't know why you'd want to own some digital thing because it's a Ponzi scheme and Ponzi schemes die when interest rates go up. Like every Ponzi scheme in history has died when interest rates go up. So it's something, I'm not short, but I'd lean short if I did anything.
So, the one argument I had because
and all over Twitter is this breakout chart of the pennant thing with the old high. And I've seen that chart so many times this weekend, and there's no way that all the Twitter bros are right. It's just never happened before.
So my kind of 2 cents of what I would kind of put in there is to say a lot of the crypto world was super excited about all the coming ETFs and everything and the securitization of Bitcoin and all of these all this crypto. But I kind of stepped back and was like, that's the ultimate saturation point. Like, and more importantly, once it's securitized, then the broader market cycles become a big influence. Like if there's a liquidity crisis in the bond markets and equity markets, and we have selling, what do you think? They're not going to hammer all their Bitcoin ETFs to raise capital? Like ultimately, by it actually being securitized, you have now taken away from Bitcoin the one biggest advantage it had, which was that it was sort of like the place to hide. It was a place to kind of be outside that market. And now with securitized, I think you've just thrown yourself right into a scenario where it's going to now just behave like risk assets, and it's going to be sold when everything is sold, and it's going to be bought when it's bought. So what's the fucking advantage of owning it? It's
it's a low beta risk asset now. It's kind of dumb, right?
Yeah.
And I think what's really interesting is that gold's been like, everyone keeps saying you got to buy Bitcoin and gold as if they're the same thing. And we've had 4 or 5 cycles where Bitcoin's absolutely crushed gold. And we're now in a cycle where gold's crushing Bitcoin. And I think trends in motion stay in motion. And the marginal guy, I think one of the reasons that gold didn't break out for the last decade, because all the structural reasons for gold to have worked in the 2010s were in place, but it stopped working. And that's because I think Bitcoin took market share. If gold starts taking market share back from Bitcoin, then Bitcoin's just it's a sale, and everyone's long Bitcoin right now. And like I said, they're going to go back to a couple hundred bips waiting gold. And no, I think anything's it's a sale.
All right.
Okay.
Let's do it.
So
uranium.
To uranium, as many people are getting frustrated that I am not asking you about uranium. So we want to spot versus miners timing. That's the first one from Jeff.
Yeah. I don't like any of the miners. If I had to own one gun to my head, it'd be UEC. I think Amir and Scott are doing a great job running the business. I think they're actual assets. They're all kind of like subscale small assets, which is why it doesn't get a lot of attention, though it has a good market cap. I think it's the only one that'll create value this cycle. But at the same time, I also think it's kind of expensive for what it is. And we don't have a position. We've had positions in the past. That's the only miner I touch. I think all the other miners are capital destructive.
It's interesting because obviously, I correct me if I'm wrong, but it was the Amazon announcement that they're going to use like modular nuclear, whatever, to power some of their different stuff that kind of spurred obviously the headlines spurred buying into the equities, which created the momentum chase, right? Like the short-term run on the upside that drove these equities. But it's interesting because uranium itself didn't seem to respond to this at all. And something like the Sprott Physical is obviously somewhat constrained by the net asset value of the actual physical uranium it owns. And so if the demand for actual physical uranium isn't there driving it higher, then that can't participate the same way that the equities are. So the question becomes, are the equities about to get a deep mean reversion? Like, is this
Probably.
yeah, like at some point when something like a Cameco goes fucking $20 up in a month, there's a point where
But I don't
it's like,
understand why Cameco would go up. They pre-sold all their uranium for basically the rest of this decade. They have no leverage to the price of uranium. They have a lot of risk, because if inflation comes back, their costs go up. It just seems like the wrong thing. I get that it's a big piece of the index. So when there's inflows into the index, they have to buy Cameco.
But so yeah, exactly. So many of the major players, the only stock they can buy is Cameco, just because of market capitalization. Like and that's kind of the funny thing is like they're just trying to put skin in the game, and the only thing they can buy to play that storyline.
Well, it's a momentum fund flows sort of thing. And I guess, there's guys who make really good money at that. And there's times where I want to, take a punt, but it's just not where I want to put real capital because, you just bigger sucker sort of theory. And it's hard. It's not the sort of thing I do. I think physical is going to over time go higher. And I think that'll drive a spot and yellow cake. We're long. But, the equities just had a huge run, and usually the equities lead, I guess, the underlying in most commodities. But physical uranium's had like 3 trades all last week. Like there is no transaction volume. Like people don't get this, but the physical uranium market, it's not a futures market. The spot market is literally a WhatsApp group. And I have a buddy who sends me screenshots of the WhatsApp group every once in a while. And it's basically like 81 bid at 85 right now. And there's been like 3 transactions in the last 7-8 trading days. And there's just nothing happening really, right? And so until that wakes up, Sput's obviously not going to go anywhere. But also, I don't think the move in the equities makes any sense because, well, most of the equities don't produce anything. They probably never will produce something. Cameco produces stuff, but they've locked all the price in, so it doesn't even matter what the price does. The only guy that's unhedged and has exposure to this is UEC. I think that's the one that's interesting on a pullback. But I don't know. Look, I remain bullish uranium. I've been saying the same thing for 3 years. It's almost embarrassing to talk about uranium because despite the amount of hours, our team here puts in on a regular basis following the uranium market, the fact is that you could sum up the entire thesis with demand is growing faster than supply. There's a supply-demand imbalance, and that gets resolved with higher prices. Like that's what I told you guys in 2021 when we first bought this at 30. It's at 84 right now, and it's the same. And when it goes past 100, it's going to be the same again. But that's the thesis.
And it's one of those things where you just can't overread, especially the spot uranium market is so illiquid and so lacks transparency. Like you can't really size up any real short-term price action, and something like the uranium trust is just going like this. The Sprott is just trading at discounts, different discount levels to the net asset value. So all you're doing is watching squiggles on something that it doesn't have true transparency on price. You just got to play the long game. You just have to own it, and fucking let time actually allow the price to appreciate to what the real supply and demand is, right?
There's been moments in the last couple of weeks where Sput issued new shares and bought some more pounds, so it goes to a premium too. I think guys like us that really follow this closely, there's a lot of opportunity. Like we see when utilities step up in the spot market, and we know it's all going to move, and we'll rip some URA, we'll take some calls or something that's really liquid, and we've done pretty well at this actually, picking up some big moves. Just because I think we have better insight than most people do in terms of what's happening in the spot market. And when the spot market does move $5-10, all the underlying QSIPs move too. But that's something that I wouldn't do that unless I was like living and breathing this one, commodity product. And, we have a guy at my firm who literally just breathes the one commodity product.
Right. Well, let's continue. And do you think that this turnaround? Obviously, we've been in like this 9-month consolidation in uranium. You think it's played its course out? You think that this is the kind of period where the worst is behind it, and this can really start to potentially trend here?
I mean, what worst? It just keeps making new higher bases. I don't know. Like the last consolidation took 18 months. This one's been 9 months, so half as long. I mean, you're the crayon guy. I do actual fundamental work. Like I can't tell you what the crayons say. In the end,
crayons look good. The crayons look good.
All right, let's hear that. I mean, look, you have this commodity where you've got what, 100 consumers of this product. That's it. There's 400 reactors, 175 to 100 consumers, and you need one of these consumers to say, you know what? It's time to, replenish our inventories, and they go for it. And then some other guys say, hey, what's Bobby doing over there? Maybe we should buy some pounds, and then it just starts rolling again. That's what took it from, 30 to 50. We went to sleep at 50 for 18 months. That's what took us from 50 to 100. And then we went to sleep at 85. I mean, we've been basically 80 bid at 85 for the better part of 9 months now. And, when some other utility says, hey, I'm not going to let that guy front run me. I'm going to go front run him. And, the offers are stacked like every buck or two higher, and it's only 200,000 pounds. So if someone needs 1 million pounds, you're going to move it $5-10. And if 3 or 4 guys each need 1 million pounds, then you have a rally. And that's all we're waiting on. I mean, there's a ton of guys who look at this and look at all the QSIPs moving around and all the shares trading, and they forget that in reality, a few million pounds moves at $5-10.
Yeah. All right. Let's continue on with some questions. By the way, Danny, I just have to say, I love the hat. Like, Kuppy, did you notice what hat he's wearing?
I love the hat. It's great.
The story behind it, like, Kuppy, you sent those out as Christmas gifts.
Yeah. Yeah, we did.
It ended up on Danny's head, and it was making volatility great again. All right.
Let's move on. So I guess we probably pretty much covered most of the uranium stuff. There are just a few people that have joined late that just want to ask a few little things that's not about uranium.
Yeah, sure.
So somebody wants to hear your thoughts on the VAL or TDW.
Yeah.
I say this as a proper bag holder. Admittedly, I bought them way cheaper, and they ran up a ton and have given back quite a lot of it. These are way better. These are, I think, more attractive here today than when I bought them, even though the price is up a lot from where I first started buying. When I first started buying, Offshore was dead. They had no backlog. They had no contracts. A lot of their vessels were cold stacked. When you look at something like Valaris right now today, I mean, it's got a 3.5 billion market cap and about a 4 billion enterprise value. And they have something like 2-point-something billion of deferred EBIT. They have, almost $5 billion of backlog now, but it's worth over $2 billion of what they'll earn after tax, and they don't pay taxes, right? Like half the market cap's just covered by deferred business they have, and the backlog keeps growing. And then they own something called ARO, which is worth, a good chunk of money. It's a Saudi joint venture in jackup rigs. I mean, you start pulling the pieces of this apart, and the price feels wrong to me. But I said that, $20 ago. It's by far my largest position, and I've been buying every buck or two down. But it's by far my largest position. And like I said, I've been basically funding it by selling all such other things. We bought Tidewater. We started buying it in the low teens. We sold some, above 100. It just felt like it was a good enough move. I've been buying it back here in the 60s. I even bought some Noble and some Seadrill. Those are probably more like trades to me. But this is by far my largest sector weighting. And it's by far my Valaris, by far my largest position.
All right. Well, quick question for you. I just noticed someone mentioning it on here, and I just figure it's a good question to ask. What's your thoughts here on Argentina? Are you still bullish this? Do you think that their equity markets can keep ripping, or no opinion?
Oh, I'm bullish. I think Malay is doing the right things. I think it's working. My problem with Argentina is that I don't know what you buy. The banks have moved a ton, but they're probably going to cancel the currency, which is going to be weird if you own a bank. You could buy YPF, but I already got enough oil. You could buy, Loma, the cement company. It's probably a great, run, but I don't know, on a EV basis, if Loma doubles from here, it's worth about the same as the Brazilian cement company on replacement cost. And, I think there's been probably deferred maintenance there. You start going through all the QSIPs and you realize that I'm really bullish Argentina, but the way you play Argentina is you go to Buenos Aires and you buy a super nice flat and they'll sell you that flat for nothing. No, I'm serious. You go buy a flat that costs you $500,000 today because you think it's gonna be worth $5 million in 5 years. Like, you're going to 10x it. You can't get financing, right? So you have to buy cash. But you buy it for $500,000 and you have a place to go visit every once in a while, or you Airbnb it, or you do whatever else you do with it. But that's how you play Argentina, right? You buy some flat that probably at the last cycle was worth $5 million. It's worth 500. So it's probably up from 250. And you ride it till it goes back to 5 million. But unfortunately, as a QSIP-based investor, I can't do that. I wish someone built me a QSIP. I'd buy that.
And just buying the Argentinian ETF is just not interesting.
No, it's all the same tickers I told you that don't seem that interesting. I mean, I think the ones that are interesting are like Ursa, Cresud, but like I don't have a super strong view on farmland, and farming never works. And I don't know, like I'm sure if you bought the basket, you'll do great. I mean, Millet is going to do great, but there's nothing that excites me. I mean, we owned the basket before and we made some money. And I think it keeps working because guys will just buy the QSIPs because it's a momentum trade. But I'm a value investor. I want to know what I own. That doesn't guess me.
All right. Well, listen, I wanted to ask you because I just saw the question.
Maybe Argentina, you buy the bonds. I know you're never supposed to buy Argentine bonds, but maybe this is the time you buy them.
There you go. I want to ask Daniel on here commented about Tesla. Like, let's talk Rocket Man. The earnings are coming out today. Any views on what we're about to see on Tesla here?
If you faded me on Tesla for the last 7 years, you'd probably have a best performing hedge fund. All I can say is that I'm glad I covered 1,000% ago. I was one of those card carrying members of Tesla Q, and yeah, those guys all went broke. I'm glad I didn't go broke.
There you go. All right, Danny, anything else before we wrap up?
No, I think it's just one question, which was just like, are there any strange stocks or countries that you're investing in right now? Can end on that one, I think.
Strange. Let me just look through my book here. No, nothing terribly strange. I literally have just been selling every QSIP to buy more Valaris. No, seriously, like the things I really like.
Double down.
I mean, we own Sprott, the entity that owns, Sput, but it also owns a bunch of precious metals, ETFs. They've had inflows, their AUM's up. It's a fixed cost based business. It should do well. I mean, Patrick, pull up a chart, SII. It's one of those tickers. It's one of those charts you're gonna love. Though you'll probably buy it at 50, and I bought mine lower. I don't mean that in a rude way. I just mean that factually.
That doesn't make it better, buddy.
No, it looks like a 2-year consolidation on a chart. I really like AMARK, the coin dealer. I'll admit that the common quarter is probably not going to be the best. It's probably not going to be bad. It's just not. I think expectations may have gotten ahead of themselves a bit. In that you're basically a beta long gold trade with AMARK, and gold's gone up. So I think a lot of guys are expecting them to have great numbers. And the honest truth is that AMARK works when retail guys go to the local coin shop and buy some coins, or they go to JM Bullion and buy some coins. And retail just is still buying NVIDIA chips instead of gold coins. And it's the most amazing thing that gold's had the biggest move percentage-wise in my professional career in a 9-month period. And retail guys are still not buying coins. If anything, you talk with management, you've seen some articles floating around. The average guy is a net seller of coins. They bought coins 20 years ago. They finally made some money. They've taken some chips off the table. We know how the cycle ends because it always ends the same, where retail builds a line outside the coin, the coin store. They did this in 2009. They did this in the 80s near the local peak. They're going to do this again. They're going to go and buy a bunch of gold coins. I mean, they did this in 2020 and 21 when gold started running and people got scared. And, you can see this in like GLD and SLV and all the other ETFs where there's not been much of inflows. Look, I think AMARC is going to moon out of control when the inflows come and people start buying coins. When guys like my dad, and especially my mom, start buying gold coins because all their friends are doing it, yes, this is the only CUSIP you want to own. But those are the gold trades I have, and they haven't really tracked gold. And that's interesting to me. Otherwise, I just like Polaris.
All right. Is there anything you think that the market isn't pricing in here? Like, obviously, we have interest rates. You've already shared your views on bonds. I don't think you need to repeat yourself on that. And obviously, there's room for the stock market to, at some point, react to higher rates. But is there something that you think the market is just not getting? Like that something is mispriced that is going to be a story for 2025?
Yeah, I think people look at the Federal Reserve and they realize the Fed has two knobs on their jet plane. They have interest rates and they have QE, QT. And they forget that the Federal Reserve, the big knob, the big one they have is wealth effect. And if they talk up stocks, people like my dad see their 401k go up, and he's incrementally more likely to take an expensive vacation or, buy a new car, or whatever it is that my dad does when his 401k is going up faster than my fund is this year. But my dad's outperforming me this year. He just owns a bunch of Mag 7 crap. It's and you look at the Mag 7, because most retail investors today, they don't even own SPY anymore. They just own Mag 7 or Mag 8 because they have some Bitcoin too. And I think all of these, except for Microsoft, are in some way impaired right now as businesses. Bitcoin's, I think, is a Ponzi scheme that's deflating. NVIDIA, look, it can't grow any faster than their customers. They effectively have 5 customers and the U.S. government, and only the U.S. government has the capacity to grow at the same rate they're growing. Right. The other customers are constrained by cash flow. Like you can't spend more money than you take in. And I think the chip wars are going to end because there's negative ROIC on all these AI investments. Look, Apple, China's going to kick them out. That's a big piece of their market. It's not really a growing business. Why is it traded this multiple? Amazon's never made $1 really of profits ever. I don't understand why it trades where it does, but maybe that one's just an outlier and they get a free pass. Meta, it's gone up so much. I mean, how much more can it go? Like, it's an advertising tied business, and I think the economy's slowing. Like, you look at all these things and you say, what if Mag 7 pulled back a third? Which sounds like crazy, right? But that's kind of where it started the year. If it pulls back a third, my dad's not going to be spending money anymore. My dad's going to be panicked about his retirement, even though he's just back to where he was 9 months ago. And I think that wealth effect really matters. And that wealth effect either gets resolved because these companies are overvalued. They've always been overvalued, but they were growing really fast. And I don't think they're growing anymore. I think they have structural headwinds, or it gets resolved because people look at interest rates. They say, why are these things 40, 50 times earnings when I can go buy a 10-year at 6% and not think about it? And I think, some combination of the two sees a re-rating, and that re-rating where everyone basically owns these 8 products. I think it's going to clip consumer spending, and consumers already kind of been slowing all year. I think the economy is actually slowing in a way. And that wealth effect, if it goes in reverse, I mean, if you look at in 2022, we had like a baby recession, I guess, or you say it was like, kind of whiplash from all the COVID stimmies. And everyone was like saying, oh, we're going to crash, we're going to crash. I said, we're not going to crash because there's too much fiscal. And the rate of change on fiscal is accelerating. Now the rate of change on fiscal is kind of flatlining. That bullwhip's kind of ending. And, I think you can actually have a recession now. But I think the other thing is that consumer wealth effect, when it went into negative, all the consumer companies started doing poorly. So, when your Mag 7 went down in 1H of 22, everyone stopped going out to restaurants. Everyone stopped buying, fancy stuff. And all the consumer companies got nuked. You had this baby recession. I mean, I think you'll have a redux of that, a repeat. And except this time, I think the Fed's going to be forced to be raising rates.
When is the inflection point in your mind, though? Is it, you think that it could just be a post-election thing, or is it something more of a 2025 story? Like,
I think it's a 25 story. No, I think we rally after the election, right? I mean, assuming Trump wins. But I think these businesses just aren't really growing. You know, they're not growing earnings. And at some point that goes against them. I mean, look, a lot of the earnings growth is that they have net cash on the balance sheet and they're just earning more interest.
Right.
And, you know, eventually they're going to have some bonds they issued in 21 and 22. They have to reprice, and that earnings will slow. I just think there'll be a sector rotation, and the world's not ready for the sector rotation. And that sector rotation, which I've been calling for like, you know, a year, and I've been early. I think that eventually has a wealth effect negatively. I mean, Americans own like nothing overseas. You know, we've no foreign assets anymore. I mean, people used to be all bullish emerging markets 15 years ago. Now, you know, Japan's an emerging market and they're kind of figuring stuff out and no one owns it. You know, China's an emerging market. No one owns it. Like, I don't know anyone who owns any of these markets anymore.
No.
That's where I'd be putting my money. I feel like the U.S. is probably, you know, over-owned, overvalued. It's just not really what I think is super exciting right now.
Kuppy, I could talk for hours, but I'm out of beer.
You're out of beer. All right.
I'm out of beer. And the conversation just can't go any further with it when I've run out of beer.
Well, it's lunchtime here. I got to get some fuel in me.
Absolutely. Listen, Kuppy, thank you so much for taking the time to join us, and I hope you'll agree to do this again. It's always a pleasure. You know, Kuppy's Corner is a favorite of all the Market Huddle listeners, and we'll definitely get you back onto the show for an update as well. But thank you so much for taking the time to speak with all of our listeners live. And you know, we look forward to bringing all of you some future guests to just come out and shoot the shit with us. I'll even I'm going to get someone out here to talk some crayons with me at some point. But anyway, Kuppy, thank you so much.
Hey, thanks for having me on, Patrick. It's been awesome. Do it again.
Danny, is there something I forgot to mention, or are we good?
No, we're good. Unless you guys want to just maybe Kuppy mention where people can follow you, or they already know.
By the way, I saw that you had some sort of a discount on your Kedem.
That's news to me.
Oh, there you go. I saw an email on this.
Anyway, I'm not involved in the marketing of Kedem. I just write the commentary.
All right. Well, listen. Why don't you give a quick plug for your shit?
Yeah. Go to Kedem, KEDM, and take a free trial. I don't think you'll trade the same, you know, once you've done it. I write a couple pages of macro every week, and then we're tracking about 25 event-driven strategies. I mean, inflection ideas usually come out of corporate events, and so I just think take a free trial and see what it's about. I mean, we've been doing this now for 3.5 years, and I think people love it. If you want to follow me, go to @HKuppy on Twitter. And prepare to be offended. It's election season. I'm fierce.
All right. Thank you so much, buddy.